All right, perfect. Hey, everybody. So obviously you got Eric here. And I'm super stoked for the segment today. I went up to Canada personally to find a good ambassador to talk to us a little bit about his strategy. So we got the good old dividend guy here. So first off, welcome to the channel. Super stoked to have you here. But I would love to just hear a little bit about your background and how you started trading, what got you into this business.
Well, thanks, Eric, for having me. And it's kind of funny because I see you through the window where it seems to be sunny and warm. And actually, I have like plenty of snow out here. So
No,
I'm a bit jealous, actually.
it's like 65. It started a little foggy, real rough. California, we're pretty spoiled here.
I know. Yeah, so my name is Mike. I'm from Quebec. So here's the accents. I'm French Canadian. I work in the financial industry for like 13 years. So I finished my bachelor degree, then started right away to work for a bank over there.
Mm-hmm.
And then I moved to investment because I really liked it. So I've been a financial planner, helping people to manage their money. And in 2016, my wife had a daycare. She got fed up, like just taking care of the kids all the time. And it's like, you start at like 6 in the morning and then you end up like at 7 p.m. So she's like, yeah, how about we take a pause? So what we did is I took up a sabbatical year and we went on a road trip for a full year. And so we traveled across Canada, across the US, and then we move on to Mexico, like it there. So we kept moving, Guatemala, El Salvador, and so on. And then we live in Costa Rica for 3 months. So that was a lot of fun. We're there with our 3 kids and so on. And I had like a small online business back then, which is Dividend Aristocrats right there. But it was just like more as a side gig at first, just to like pay for like fun stuff.
Sure.
But then as I was doing this, I kind of realized, oh, wow, like as a private banker, I can help like 300 clients roughly. And now I can help like thousands of clients with their portfolio. So I kind of like that. I kind of like the flexibility also to be able to move around and then travel whenever I want. So when I came back in 2017 in Quebec, I just decided to quit a job at the bank and just start full-time working on DSR and build it into a real business, and just instead of just having this as a side gig.
Right. Got it. So out of college, you said that you kind of went into finance. What kind of work were you doing?
It was kind of funny because at first I wanted to go into marketing.
Okay.
And then I had like a session in Europe. So I was trying to get myself a job like when I was going back during summertime. And I ended up in a clearinghouse trading futures and options.
Oh, super cool.
So yeah, so I started in the back office there, and then I realized, oh my God, this is like so exciting, And then I discovered like you can trade pork bellies, and I was like, oh my God, that's very cool. So when I came back to college to the last year, I decided to finish with 2 majors, like in marketing and then finance.
Got it.
And then I got a job over there, but I quickly got bored because like the trading aspect is like very amazing, but at first the entry level is like you're just balancing trades in an Excel spreadsheet.
Yep.
So after 6 months, I was like, wow, this is like pretty boring job. It's not as sexy as I thought it would be.
Right.
So I started to look around, and then there was a partnership where we were doing like credit and then leverage loan for investors. So I started pretty much like a credit officer for like 5 years. And then I decided to move on the other side of the table and become a financial planner to meet clients and help them with like, estate planning, retirement planning, and so on, just to do like the global overview and do investment at the same time.
Mm-hmm.
And I knew that was fun, but I also wanted to have something on my own. So this is when I started to write blog, and this is like the name Dividend Guys because I bought the Dividend Guy blog in 2010 and decided to move towards the strategy and then build like bunch of blogs around that, and then eventually Dividend Aristocrats as a membership website. And this is how I started to really like build my interest for finance, and at the same time my work.
That's really curious. So that bit about starting and clearing for derivatives, and then you've transferred, obviously now your business is, focused around dividends in general. What led to that path for you?
Well, actually, it's kind of funny because when I started at the bank, the first thing I did is I went to get a line of credit. So
Mm-hmm.
I told them, yeah, I just got a job. I'm going to get married. So I need a line of credit for my marriage, but it was actually just a trade. So
Yep.
I started like, I started with $3,000 on the line of credit. That's what I told my girlfriend who became eventually my wife for real. So that's good news. And then 2 months later, I was like $19,000 withdrawn from the line of credit out of 20, trading, like buying and selling all the time, having a lot of fun doing that, and spending like probably more time watching the stock market than working. This is because like the job was boring, so I just was like, oh my god, and it was like during the good years. It was in 2003, so between
Yeah.
2003 and 2006, it was just like a lot of money to be made, and a monkey could do it, so
Yep.
that was great. And I bought my first house with a portion of that. So fortunately, for me, when I went into 2008, I didn't have much money invested. Everything was in my house.
Got it.
But then I started to have kids. I was doing my MBA. I finished my certified financial planner title, and I was getting very busy. And I couldn't spend like 4 or 5 hours on the market and watching that and doing like those swing trades all the time. And this is where I started to like get interested into another type of strategy. And at the same time, I was like buying and selling personal finance blogs.
Mm-hmm.
So I had like this small business on the side with one of my partner, and we just realized back then we could just like sell advertisement and make a good living out of it. So that
Got
was
it.
just like good money, was fun. And eventually we thought, okay, so we're gonna buy like larger blogs and one that was for sale, because I noticed I was following that guy, the dividend guy blog originally, and he started to post like less often. And then I
Mm-hmm.
thought, well, maybe I can reach out to him and see if he's interested in selling, because he was
Interesting.
ranking like on Google for plenty of keywords and so on.
Right.
And I bought the blog, but at first I was like, okay, dividend investing, whatever, it's like one strategy, but I was not necessarily like interested in it. But the
Mm-hmm.
more I read, the more I looked at like the fundamentals. And then I realized, oh, okay, so I can focus on dividend growers, because it's just not about the yield. So like
Right.
most of my portfolio, like my average yield is probably like 2%. So some people even tell me like, you're not really the real dividend guy, because you're supposed to have like a yield around 5 or 6% or something like that. But it's really all about the growth. And it was like a very important factor for me that could help me save a lot of time and still be able to do like a good return, and not spend that 4 or 5 hours a day that I was spending, and I could spend it on my kids instead.
Got it. Yeah. And that makes a ton of sense. I think that that's one of the things, definitely a downfall of trading in general is, the more active you become, the more of a time suck it is. Like you can try to deploy certain strategies, but depending on the market, you got to go through that process of analyzing things and finding what works and whatnot. So it makes a lot of sense for the move into dividends. So when you first started kind of in the dividend space, what were your initial thoughts? Were you thinking like, yes, this could be suitable for me long term, or were you thinking, I don't know?
Actually, I thought it was suitable because I understood the studies behind it, and then most of
Mm-hmm.
it will tell you that you can easily beat the market if you just like buy and hold like great companies.
Right.
But I came in with like a set of metrics that were like very strict. Like I would discard all stocks with a yield under 3%, for example. So back then I was maybe really a dividend guy, but
Right.
then I had like specific sets of payout ratios and so on. And I didn't want to move that at all until I discovered like one company that didn't fit those metrics, but still was amazing. Like one of them was Disney, for example. So Disney back then was paying like a 1% yield, but showed amazing growth. And I thought, okay, so maybe I need to modify my approach a little bit to help me like find those companies. So I had like that was that time where you evolve as an investor, and then you find what works and what doesn't. And then I realized that I was more interesting into dividend growing stocks instead of just companies that were boring and just paying a yield. And I modified my approach a little bit like this, but I always kept like 5 to 10% of my portfolio for speculative plays. just like in and outs. I don't know, just to remind me of the good old days where I was doing that all the time.
That's pretty awesome. So it's funny you mention about like the speculative side of your portfolio, because I am a huge advocate of like splitting even my portfolio up. So even though I trade, market just closed. Even though I trade just primarily derivatives, I still have like very different products and strategies that I will trade what I call like my core holdings. And I call that like my general bid for success. And that's a lot less speculative in nature. And then I have a speculative side where I do pretty much exactly that, where I will scalp, I will do all of the hood rat stuff that probably doesn't make a lot of logical sense long term, but I'm like, I'm a degenerate. I can't help it.
Yeah. And it's kind of like you add some fun to it, because if not,
Yeah.
I mean, just running your strategy, which like good results, but not extravagant either, and then you're just waiting. I don't know, I just find it boring sometimes.
Yeah,
So
it can be. And so I think my mentor always had like such a great way to think about it, because he always said like your core holdings, it should be steady state. It should be something that you can rely on long term. And then for the speculative side, that's where you really get to like take your shot. If you have a hunch about something, there's like, especially as you stay in the market longer term, you start to build up just your market IQ and you get used to pattern recognition. And, a lot of times our brains, I don't know if you've read Blink by Malcolm Gladwell. It's a great book, but it talks about the subconscious and how our brains do a ton of processing that it's not even cognizant to us. It's just happening in the background. And that happens with trading, especially once you look at it for a really long time. He always tempered that with, don't ever think you know anything, because you don't. The markets can do whatever it wants. But, there's nothing wrong with taking speculative shots, because sometimes, I mean, they do pay out. They can absolutely pay out and enhance the overall returns.
And as long as you set your rules straight for that, and you don't go say, okay, now I'm at 10% of my portfolio, but I see another play, so I'm going to go up to 15 or 20. This is where it gets dangerous, right?
Right.
But if you stay to your strategy, whatever the percentage is, and that, as you mentioned, I think like there's a lot of strategies that works. And the one that works best is the one that helps you sleep well at night. So the one that that you understand, that you feel comfortable. So that is your core portfolio. But then I kind of like the fact that you can also add this. It's like, I like comparing it to like cooking. So you can have like a nice soup, but then you can like throw in a few spices in there, and then get that spike where people are just like, oh my God, like what's that taste in your soup? And this is the speculative play.
Yeah. I love that. So on that note, out of general curiosity, with your like general holdings, what is like a high level, you don't have to go into super far detail, but like what's like a high level approach that you like to take?
What do you mean by high level approach?
So you mentioned that your overall yields are generally on the lower side. You try to focus on like growth stocks in some capacity. What other, like for risk management, for example, what kind of risk management do you like to apply to kind of your core side of your portfolio? Those, the larger number of your holdings that you're planning on holding longer term, those sorts of things.
So I have an unreal risk tolerance in terms of investing, like meaning that even though it's dividend stocks, so it will not likely go down by like 80%, but I wouldn't mind. I wouldn't mind at all. That I always had a high risk tolerance, but once I crossed the borders like El Salvador and Honduras with my family on foot, and not going to Roatan, but like just really walking to the villages where like murder per capita is like amongst the highest levels across the world, losing money is not really like in my on my fear scale. It doesn't even exist. I'm just like, yeah, whatever. I've lived like five for a year. We live like five in like a one room type of like RV. So I don't mind losing my house and so on. So I don't really mind that part. So I'm always 100% invested, 100% equities. And the way I do it is for like 90% of my portfolio, what I use is like three metrics to keep it simple. And then I go a little bit further, but the basic is what I call the dividend triangle. So I'm looking for companies that has like three metrics that are growing, which are revenues, earnings, and dividend. So in general, what it means is you're going to look for companies that has like dominant presence in a market, great market shares, brand recognition, pricing power. So innovation, grow by acquisition strategy. So all those factors will help them to grow their sales.
Right.
And then I track the EPS to know, well, because I wish I could do it with cash flow, but cash flow is super hectic. So it's a little bit harder, but it's real money. I know the difference, but unfortunately it's harder to track it over 5 years because it goes up and down all the time.
Right.
So I rather trick earnings for that reason. But the point is you make sales, but you also must make profits, and both of them should increase. So meaning like healthy margin, and then you can manage, like, whenever it goes into a recession, you know how to manage your cost and just have like a robust balance sheet. And the third one is the growth of the dividend. So in an ideal world, you would see a company that is able to grow all of them pretty much at the same trend.
Mm-hmm.
And whenever there's a jump or there's a drop within that 5 years graph that I look at, this is where I'm going to jump into the financial details and understand like what's happening there. Is there a story? Is there a good reason? Or the company's just now not doing so well and I should just get rid of it. So this is how I start my stock screeners, just to start investing a little bit. And obviously I have like some sectors that I prefer, like tech stocks, industrials, and consumer staples, which are good because you can pick them up during recessions and they're usually lower. And this is where I can get most of the growth. So then I got like some, what I call deluxe bonds, like boring companies like utilities, for example, some consumer staples. In Canada, we have Canadian banks that are amazing because they show a pretty good yield, like a 3 to 4% yield with a constant 5, 6, 7% dividend growth rate every year, but they generally outpace the market at the same time. So it's like one of the best investment that you can find. And the reason why they are able to do that is they're heavily regulated by federal laws. And for one reason, for example, in 2008, when there was the credit crisis in the US, bank stocks went down in Canada too, but actually none of them suffered, like no losses, nothing. So they increased their provision for credit losses. But the thing is, it's not because they're smarter, but they were not allowed to do subprime mortgages, for example. So for them, it's impossible. They can lend up to 80% of a house value, where I think in the US, it went up to like 125 at one point. Just thinking, oh yeah, Rick, so you're buying that house. You don't have the money to pay for it. You have no cash down, but
you just figure it out. Yeah.
You figure it out. Or if not, you're going to sell it in 6 months and make like 50% profit. So
what could possibly go wrong?
Yeah, there you go. So it's kind of funny because I'm pretty sure Canadian banks wanted to do that too, but they were not allowed. And this is make them a safe investment, but at the same time, they're like fully protected. And it would be almost impossible for a US bank to enter the Canadian market, like for laws and so on, because you need licenses and stuff. So they're pretty much sheltered in their fortress and they're just making money. They have like this oligopoly. So this is the kind of place that you can easily put your money in and just sleep well at night.
Yeah, that's an interesting point, especially on the difference between the ways that the banks work. Do you think that long term that would potentially hamper the growth of the Canadian banks, or do you think that oligopoly is strong enough that what is there, like 5 or 6 major banks there, something like that?
Yeah.
Do you think that there's enough mutual space between those banks that each of them could survive, or do you think that they're going to keep funneling down and consuming one another?
Actually, what we see so far, especially for the past 10, 15 years after the financial crisis, is they're using their strong base in Canada. And obviously at one point, you're right, it's pretty hard to grow within the country. I mean, it's a relatively small country. Players are everywhere. So, I mean, there's a limit of branches you can open, and then like I steal your client, you steal my client. And then we're at the end of the year, we're pretty much even, whatever. Yeah. But what they do is they use that source of profit to explore other type of income. So you're going to have Scotiabank, for example, that went into South America. So they decided, so you know what, emerging markets, countries that should have a higher GDP moving forward compared to US or North or Canada. So they decided to invest it there. You have Bank of Montreal and National Bank. They decided to go through wealth management, more capital markets. So trading with ETF, market liquidity, doing futures. I'm pretty sure they're going to come up with like other products related to cryptocurrencies at one point as well. So they went a little bit sideways on this part. And then you have like TD Bank that is like now generating like 1/3 of their business from the US.
Yep.
So again, another source. So, they just like use, okay, so I have like this printing machine in the back store, just working well in Canada. And then I'm going to go elsewhere, see if I can grow. So I think they're going to be able to continue to grow this way. But if they like put themselves into the country and do not expand, like smaller banks tend to do that because they don't have the means to do it, they will have a hard time.
Got it. Do you know what the just general perception is of Canadian banks, and I guess really just infrastructure in general to like cryptocurrencies? I know it's a very like specific question, but I'm just super curious if you have a feel for that there.
Actually, it's kind of funny because I have this ongoing conversation with my partner, and he's working at the bank as well, and then we keep having those chat about DeFi and how it's going to affect banks and so on. Right now, and I've dabbled a little bit with that, and then I kind of find it incredible that you can lend US dollars at like 3, 4, 5% easily on DeFi, and then some other sites offer like even 15%, which is kind of crazy, and then you go to the bank and they say, oh yeah, we're gonna give you a GIC of like 1.5%, and we're gonna lock it up for 5 years. So obviously it's a part where they're missing the boat on that, and at one point I think it's going to grab some profit. We see it as well for especially in the stock market, because you open a brokerage account, you have your stocks over there, and your broker can lend those stocks to investment bankers or whatever, like institutional traders, hedge funds, to do their trades, and they're making the money on it. But as a retail investor, we make nothing.
Right.
So in the DeFi world, we would be able to lend our shares of like JP Morgan or whatever, and then earn some interest on it.
Right.
And those doors, they're going to take time to open because there's like a whole bunch of regulations to make it sure that it works for real. And then you just don't wake up one day and you have no more shares.
Right. Yeah. They're just zeroed out. Yeah.
Yeah. Because
some 12-year-olds hacking you and you're like, well, great. It's all gone.
Or even worse, you just lost your wallet like key phrase, and you're just like, oh my god, I just lost my Roth IRA like in the wind just because I can't remember those freaking names that was written on the piece of paper. So this part needs to be articulated a little bit, but at one point I really think that banks needs to look at it, and we saw that it's Société Générale in France, a big banks over there, that they're looking at issuing bonds through DeFi as well.
Interesting.
So I think they're walking into it, but like gradually, very slowly. But obviously, it will be good for a part of the population, not necessarily for everybody. It's pretty much like, I remember like roughly 20 years ago when we had like digital banks coming in Canada saying, oh, like they're gonna tear up like the classic banks apart because you can like have like higher rates on your savings account. I mean, that was cute, but they ended up not making that much money. And actually Canadian banks actually bought all competitors just to include themselves in their portfolio. So there will still always be a need for advice, not for DIY investors for obvious reasons. But when I think about like my previous life at the bank, the last 5 years, I was a private banker. And what a private banker does, like my job was to take care of business owners. So business owners with businesses with like at least $3 to $5 million revenue and up. But those guys, they have trust accounts, they have families. Most of the time they have divorce as well. They need like estate planning. You cannot go on your computer and just manage that. You need someone to take care of that type of things, So and this is likely the client that bring in the most money for banks, not just a retail investor that has a steady job and saves like a $500 a paycheck and invest that in index funds.
Right.
Those, I mean, they're going to get them, but they're not that profitable compared to like people with like more complex situation that don't really mind paying a little bit more just to get good advice.
Right. Yeah, that's a really interesting point. And like one of the things I've been following really closely here in the US, I have a few friends that are in just cryptocurrency, blockchain technology and things like that, is just the overall adoption, of the technology for the banks. Cause I feel like the banks in general, I feel like they're in a weird scenario because in a lot of ways they're disincentivized, but because of the overall adoption curve, they're also incentivized to do it. So do you think that, in the next 10 years that you could go to a bank and interact with cryptocurrencies at a physical bank location, like sign into your account there or whatever and interface with them? Or do you think it'll be slower for the Canadian banks?
Canadian banks are quite conservative.
Got it.
But at the same time, I've seen a graph where they were like showing the adoption of cryptocurrencies compared to the adoption of the internet. And it's following the same trend, exactly the same trend.
Never would have guessed that.
And it's kind of like impressive and scary, like at the very beginning of internet, like maybe like in the 90s, for example. But now you're thinking, and I can put myself back there. I was all about like, I want my like 56K modem, and I was all excited about it. And even my parents were just like, why are you spending so much time on your computer? They didn't get it at all. And I kind of feel that now banks are looking at crypto the same way. They're just like, yeah, whatever, but there's a huge world building behind it. And definitely there's a lot of things that are like super easy and super fast to do. And just thinking that you can like one day tokenize your house and then be able to lend a part of it and then make switches and so on. That would be just, like to the tip of your finger.
Right.
Versus today that you have to meet someone at the branch, bring on like tons of paperwork and then sign tons of document and go back and forth and negotiate the rates and so on. And then it takes like, at the fastest, it's going to take a week. And that's like super fast.
That's if everything goes right. Yeah.
Yeah. So, and then with crypto, well, technically you should do that within the same day and probably within a few hours once everything is like settled, like maybe in a few years. So I think the first part will go through trading for banks. So they will have to go there either through ETFs or either to like having like platform that enables you to connect your wallet and then buy or sell cryptocurrencies. Then it's going to go through wealth management because rich people will want to have that part as an asset, maybe.
Right.
And then it's going to go into like the classic savings and loans, but I'm not sure it's going to take, I think it's going to take more than 10 years to go there.
Yeah, it's interesting. Yeah, I was talking with one of my good friends, like I said, who's in the space out here, and he was saying even the US banks, they're not necessarily trying to make significant strides very quickly because it does seem, it's almost like, I don't know, like it feels almost like a forced adoption where if the banks could make it go away, they probably would, it seems. And then, but the people are like, no, we want this, this is kind of cool. I imagine
it's pretty much like a parents with their teenagers, because the teenagers are just like, oh, I have the world in front of me and everything is cool and everybody's happy and it's all good and there's no risk, right?
Right.
And then you have the parents that's like, dude, you're gonna hit a brick of wall for sure. Like it's not gonna work well at one point. And just the fact that you can do all of those transactions so fast, it's going to open up the doors to so many frauds. And even if you can trace it back on the blockchain, people don't care. Like with ETFs, it's the same thing, like electronic fund transfers and stuff like that. It's the same thing. You can trace the account that they received it, but they withdrew the money and now they're living on an island and good luck finding them. So they don't care about the blockchain at this point.
Right. Yeah. And I mean, it's like in terms of moving money, a lot of people, because it's so simple to set up a wallet and you can set them up in ways that they're not even really attached to you. You just have access to it. So, I mean, it would be very conceivable to just move funds between a handful of disjointed wallets. And then, that would be pretty tough to follow, I imagine.
So that's why they're pretty much on the break at this point, I think.
Yeah.
And the more regulation you add, well, unfortunately, the more it's going to look like a bank.
Yep. And the slower
it's going to be like not that speedy and convenient, and you're going to lose that part as well. So
yeah. So looking back at the past year, I would be curious to hear a little bit about your general approach to the markets and kind of how you have handled really the post-COVID moves, because I was talking quite a bit about it last year when we went through the COVID drop, and we just had this unseen recovery. Normally bear markets are 250 plus days, something like that. And, that one was like 30.
Yeah.
So,
you better not go on vacation during that month, because it's gone.
just so different. So yeah, I would just be curious to hear how you approach 2021.
Actually, it has been some kind of like a frustrating year.
Interesting.
And in a sense that it went well, but the fact that I'm always 100% invested and I've done very well over the past years, that meant that this year, when, like, for example, I'm not big on energy. I don't like oil and gas stocks because they go up and down all the time, and they make very poor dividend growers because they always depends on commodity price. So I obviously missed that train. And then my portfolio is up like for a good amount, but not like up 25 as the rest of the market. I'm maybe like up like 15 or 20%. So, but not that good. And it's kind of like feel frustrating to say, oh, I'm going to stick to my strategy, but my strategy implies that sometimes boring stocks, you have to underperform. On the other sides, I know that like a year like 2018, when everything dropped, my portfolio wasn't positive. So it's kind of like a weird feeling. I didn't expect the market to go that way. Like it's just, at this point, I felt that we're creating a generation of investor a little bit like I felt when I started in 2003, where you buy pretty much anything and then you can flip it back in 6 months and then make money out of it.
Right.
And it creates this, I don't know, this illusion that making money on the market is easy. That you just have to open an account and basically type any type of symbols, do any types of strategies, and just make a lot of money out of it.
Yeah.
And now you look at like stocks that we had, like a bunch of meme stocks at the beginning of the year that was just crazy with basically no fundamentals. Right. But even not too long ago, like when Rivian went into the market, I mean, I almost sold as many cars as they did in their entire history, and they're like valued as much as Volkswagen. I was just like, yeah, explain that to me. And especially the car industry is like super competitive.
Yes.
Capital intensive.
Relatively low margins.
Yeah, so I'm like, it's not exactly a place where we're going to start buying like 5 cars per people.
Right.
Or having like margins increasing by like 10-15% year after year. So I'm not sure I get the enthusiasm. Like, I know, like, I'm super happy that we're moving towards electric cars and so on. That's not the point. But I'm just like, yeah, but like I'm just, you're going to buy like a bigger and better TV, and it's going to cost the same thing as it cost 10 years ago. And there's not much money out of it to make out of it because, technology evolves super fast. So it's just another piece of technology, which is really cool to have. But I don't see that as like a money-making machine. Not that much. So you have those like strange waves of like market, and then sometimes it also sounds like 1999, where you used to pay for page views and clicks.
Yep.
Now you pay for like great technology and hype, and then like I have the coolest company, so you should like buy shares. Not too sure. I mean, you saw like AMC just like open up and then say, oh, we have like this brand new like membership, and then the stock surge on like a membership level for movie theaters. I'm like, yeah, that's cool, but
I feel like a lot of those places, I'm not sure how close you follow just like Reddit and the forums on there, but a lot of those places, or a lot of those companies, they start to get like purposefully poached by investors, because essentially what they try to do is incite a short squeeze.
Yeah.
And as you get enough, I actually love that that's happening, because forever that was only institutions could do that. But now we're at a point where we have literally retail traders that are scanning for heavy short float, and they're trying to band together like these little clans and say, oh, let's go after this one.
Yeah.
And it's always the most disorganized bullshit thing you've ever seen. But sometimes it works, man. It worked with GameStop. They tried it with Hertz. They did it with AMC. Like, I feel like a lot of those places become sensationalized because of the amount of short float in there. And people are like, well, there's an opportunity here. Let's see if we can, moon this thing and get ready to cover and just drive this price up. It's kind of crazy because, like you said, it departs a lot from like the fundamental side of things, because who the hell looks at a place like GameStop and is like, yeah, they're going to be around 10 years. That's the next Blockbuster. I have an Xbox. And if I want to buy a game, I just buy a digital game and download it. I can't tell you the last time I've been to like a physical game store.
I know. The one thing it's good from them though is I'm not a big fan of like short sellers because it's like going against the market.
Yeah.
And I'm like, I get why they do it, and they're making money out of it. It's fine. It's good, but it's kind of like not the purpose of investing, So if they can get like caught red-handed and then just get their hand slaps here and there, I mean, I kind of smile for that. Yeah. I kind of like it.
I just loved seeing all the retail traders, all these degenerates that they applied no thought, but they just saw somebody else said, buy this. And they're like, okay. And all of a sudden, I mean, they're literally causing big institutions. I mean, Robinhood got, oh my, they got rid of the buy button, like, they literally were trying all sorts of things to slow it down. So I like seeing that side of things, just disrupting the way things have been done, because traditional finance, as I see it, the quote unquote big people, the corporations, the hedge funds and things like that have had so many structural advantages. I'm not sure. I assume dark pools are a thing in Canada too.
Dark pools.
Yeah. So in the US, there are entities called dark pools. And essentially it's a way for transactions for like big transactions to be processed, not on the open market.
Oh yeah.
So it creates this awful effect down the line when there's a big unwind, but the people that really feel that unwind are the retail traders. The institutions are able to still navigate their way through it off exchange, which is huge.
Yeah.
So
and they see all the flow of information and trades going, which you and we don't. Like, exactly. We're just like, okay, so we're just going to open our small brokerage account and try to make a trade here.
Yeah, and we're just, oh, this looks good. Yeah, and it's crazy because, I mean, even with a lot of like the dark pools and things like that, they have like delayed reporting where an exchange will happen and then it gets reported like the next day, and you're like, well, I would have loved to have known that 30 million shares of whatever just moved. That would have been dope. Thank you guys. And yeah, so I do like it when the little guy every once in a while gets to like stick a thorn in the giant's foot, be like, fuck you guys.
Definitely. So there was a lot of like this kind of like weird stuff happening in 2021. I try to not to go too much into that bandwagon just because it's really outside of my strategy. So but for now, for the time being, this year was just like, and this is where I need to remind myself, okay, let's go back, not 12 months, but let's go back for the past 3, 5, 10 years and say, okay, the strategy works. This year is not like, I'm not beating the market, and it's kind of like funny. I'm not used to do that. Like usually I beat the market like year after year, and I'm like, what's happening? I'm like lagging like 5-6% behind. What's going on? Right. But it's just because the level of risk is different. And the appetite for like boring dividend growers will not be like super hype right now. But I think it's a good thing because now it gives me more opportunity to buy a little bit more of them at a better price. and I can like trim up to like those great, like I had like a huge position in Apple. So whenever I need cash, I just like sell a few shares of this one and then go into something that is maybe like didn't have that amazing run, for example.
Mm-hmm. So one of the things I'm curious about is for your typical holdings is, do you only hold things that pay dividends, or do you also have like non-dividend growth stocks that don't fall on your speculative side? Like, are there actual things that you involve in like your main strategy that don't pay dividends?
I have one. Well, actually, I also have Disney now because I kept it even though it suspended its dividend. But
Yeah.
I bought shares of Amazon back in 2017,
Mm-hmm.
but it was in results of doing an analysis of Walmart and Target, and then realizing that if I compare the three of them together, for me, the clear winner was Amazon.
Mm-hmm.
And I thought, okay, I'm willing for once to step outside my strategy because I believe the future of retail is online and not within those huge retail, brick and mortar retail.
Right.
They actually surprised me, to be honest. I didn't expect them to do that well. At the same time, from time to time, I look at Walmart and then just, they publish like, oh, digital sales is like up like 50 or 75% or whatever. But then you look at revenue growth, total revenue growth, and it's like 3-4%. And then people are get all excited. And I'm like, yeah, well, look at Amazon, they're double digit all the time, but it's just real revenue double digit. But yeah, so there's this one. If not, it really goes into the speculative place. So it's really all about dividend growers where I can, and I'm relatively active for like a dividend investor, meaning that I make maybe like 3, 4, 5 trades a year.
Mm-hmm.
It's not a lot compared to like real trade, like people that are just moving all the time. But in the dividend world, it's still, I always like review all my stocks every 3 months, and I always make sure that I don't like go over exposed to one sector. I like to have like maximum like 20-25% maximum in a specific sector. So right now I'm like getting closer to 30% for the tech stock. So I'm going to start selling some and then buy another sector for that reason. So I'm trying to get really balanced. And I'm having just my fun with that 5 to 10% speculative plays, where at this point, when there was, I think it was like Citron report that went with, it's a hedge fund short seller. They issued a report on Shopify, for example, and then Shopify tanked. So I bought this one and then flip it. I rode the cannabis bull market in Canada because there was like all those like cannabis companies. So I thought, you know what, I'm gonna buy one. Just gonna like put a stop sell at one point just to protect my profit. So those are like the type of speculative plays I like to make. I've entered into a buyout one this year, actually, in Viacom, when actually the stock crashed because they were the hedge fund was forced to sell all their position. Never went back up so far, so I'm still waiting on this one. But in 2020, it was like a very good year to make those like flip trades. Made some of them, so that was great.
So what's like your average holding time for like your typical dividend plays?
Most of them I intend to keep them forever.
Got it.
The thing is, after 5-6 years, sometimes they shifted strategies or the environment changes. So I like to let my winner runs. And this is how like I build up that huge position in Apple, because I bought it like in 2014. And then since then, I'm just trimming it for rebalancement purposes, but I'm still going to hold it forever. Mm-hmm. But I have like, when I switched my strategy towards dividend growth investing, that was between 2010 and 2012, where I put all my money there. Most of the holdings back that I bought back there, I still have them in my portfolio.
And just a random question, aren't taxes for you guys like pretty rough for trades?
It's pretty rough for everything.
Fair enough.
But yeah, no, I mean, we just love getting taxed, right? I don't know, like go figure. Actually, I know it's a bit off topic. I'm going to get back to your question, but it was super funny because my wife, for a very long time, she was at home and then she had the daycare, but most of the time she was just stay-at-home mom. And I was obviously making a very good salary as a private banker.
Sure.
But I was the only salary in the family. And we're getting we get our marginal tax rate getting higher and higher and higher. And at one point, I was making more than my neighbors in front, but they had like two equivalent income. They were both working.
Right.
And I was ended up paying I was making more than them. And I was paying maybe like $25,000 more in taxes, but for making $3,000 more than them. But the thing is, they don't hit the marginal tax rate at 50%. And on my side, most of my income was at 50%. And I was like, can I split my income with my wife? Because it doesn't make sense. She doesn't work. Yeah. She's at zero. So I should not be taxed that much. I still have 3 kids to feed. But those are inefficiencies. So yeah, we love to get taxed. Fortunately, we have a lot of tax sheltered accounts in Canada too. So all my investment right now are not taxable. It will be taxable the day that I withdraw from them.
Right.
But in the meantime, I can earn dividend, I can make profit, capital gains, and so on, and nothing is taxed. So
got it.
So far, so good. Yeah.
Yeah, because there's a few dudes on my channel. I do a live session on Mondays, and a few of them are Canadians, and they're always I'll bitch about the taxes that I have here sometimes, and they're just like, hey, why don't you shut the fuck up, because you have no idea. And I'm like,
it's disgusting.
It blows my mind, and it feels like that actually ends up having to be part of your guys' strategy is just tax preparation, because
it's a big thing.
Yeah, because that's a meaningful. I get pissed off about 40%, and then and then you guys laugh at us.
So you get the sun and you get the low tax rate, and you still complain.
Exactly. Yep. Exactly. So another question that I had, especially from just a pure dividend perspective, I talk about this quite a bit. I saw it the past year specifically with something like ExxonMobil here, but just what I would consider a yield trap, because it seemed like a lot of places were getting just demolished and still just raising their dividends, seemingly, to try to bring investors in. But it seems like you, in the way you deploy your strategy, would typically avoid that, because most of your dividends seem to be around a more manageable number. Like you said, you're not chasing 5, 6, 8% yields. You're chasing, 2, 3, something like that. I'm curious if that's specifically part of your strategy to avoid yield traps like that, or is that just a byproduct of the way you deploy?
Yeah, well, the thing is, when you invest in high yielders, especially for the past 10 years where interest rates are super low, it doesn't really make sense, right? There must be a reason why you can get bonds paying you 7%, or unless it's super junk bonds, you cannot get GICs, you cannot get anything to pay you 7%. And that company over there is going to offer you that. Well, you have to start asking some questions about that. And the thing is, I've realized that most of the high yielders eventually, whenever they hit they go very well when the market goes up and the economy is healthy. Whenever there's a recession, they start cutting off. They're just oh yeah, well, by the way, we can't afford it anymore, and then we just cut down the yield. So I want to avoid that as well, because obviously when you pick up on dividend cutters, well, usually 6 months to 12 months before the dividend cut, the stock price goes down all the time. So the market see it coming. And as I mentioned earlier, when I'm looking at the dividend triangle, well, most of the time, if revenue goes up, earnings goes up, and dividend goes up, the yield cannot be that high.
Right.
And I had this funny conversation in 2020 in April, because I was debating the fact that when the stock price drop, regardless if there's a dividend or not, but you brought up Exxon, and the discussion, the example I used was Exxon.
Funny.
Yeah, and I was like, you know what? It's not because it's lower now and it pays a high yield that it's undervalued. And then I had this discussion going on, and I'm like, you know what? Let's bet $5 just for fun that Microsoft, that back then in 2020, in April of 2020, Microsoft is already greatly overvalued by most people. And I'm like,
Sure.
okay, so let's pick a very high quality company with a very strong dividend triangle. Actually, like revenue, earnings, and dividend are going like this, like for the past 5 years. It's almost perfect. So let's pick this company and let's put it against ExxonMobil and see how it goes.
Right.
And so far, Microsoft is like maybe like 30%, and the wager was over a 2 years period.
Okay.
Just to give enough time for the energy sector to recover at one point or another. And back then, we were back in April 2020, so really in the middle of the pandemic, no expectation of vaccine, or we didn't even know what was going on at that point.
Right.
And it's kind of funny because the energy sector got lucky that we all got lucky that we got vaccines right away. And then the economy started to reopen that fast, because if not, the oil and gas industry would have not rebound that fast. But still, even with that recovery, and even if you had have bought ExxonMobil at a very depreciated price, Microsoft still did better, like by almost 30% as we speak, depending on the days. Sometimes ExxonMobil was winning, but the fact was, you pay for something that is really, really high valued versus something very, very technically undervalued. And in the end, there's not a clear winner. And if there's something, maybe the overvalued stock will continue to overperform. So it's kind of like a kind of interesting twist here, that this is why I decided to go after dividend growers. And, now we have this big talk about inflation. It's been going on for like a good 12 months now that we have like steady, very high inflation. Like not too long, the Fed said, oh yeah, maybe it's not temporary anymore. Maybe it's going to be there for a little while. So I guess, I don't know, but again, inflation is most of the time, it's like a self-fulfilling prophecy. So if we all think it's going to go up, well, we're all going to rush into the stores to buy stuff and then create more demands and then change supply disruption, and boom, you get more inflation. So at the same time, I'm not convinced it's going to go on forever. Central banks have plenty of tools that they can do. Unfortunately, they're going to raise rates at one point just to slow it down. But the point was, while there's inflation like this, my companies that I have in my portfolio, they increase their payment by like 5, 6, 7, sometimes 10% a year. So I don't really care about inflation because my dividend payments are always higher. So obviously, the stock price might go sideways if we enter into a high inflation period of like five years. Studies have showed that regular stocks don't perform that well. At the same time, it's hard to go back in time as well, because the real high inflation period that everybody has in mind were in the 70s. And mind you, in the 70s, dividend growers, there weren't that much. You had like Johnson & Johnson and 3M, but I mean, it's been 15 years. And there's only like not even like 20 stocks that are classified as dividend kings, showing like more than 50 years of consecutive dividend increase. So most of them started in the 70s. We didn't have like companies like Microsoft or Apple back in the 70s either. So we don't know the, the approach of technology, how it could affect inflation moving forward. So all of those factors lead me to believe that we might not necessarily run there with like gold going crazy and then hitting stagflation. So, but if you look at the past 20, 30 years, we didn't have much inflation either. So it's really hard to know what's going to happen next in this type of environment.
Right. And you mentioned the dividend kings. I think I'm used to hearing the list of like dividend aristocrats. I assume that's probably the same thing, where it's like an increasing dividend over the last, I think, 50 years or something like that.
Yeah, it's exactly the same thing. The dividend aristocrats is 25 years.
Okay.
And the dividend kings, it's 50 years.
Okay.
But I mean, you don't hear about them often because, as I said, there's like 20 stocks that did that. So it's quite a feat.
do you use like the dividend aristocrats, or do you prefer dividend kings, like if you're evaluating something between the two of them?
Actually, I even prefer sometimes to look at companies that will eventually become like aristocrat or dividend king.
Interesting. So like before they make the list necessarily.
Yeah,
Got it.
For me, if a company started to increase its dividend 3-4 years already, that's enough for me to have a look at. And actually, most of the time, if you're able to pick them up within the first 5 to 10 years, this is where you're going to get the most out of it. Because, you know, to be able to increase your dividend for 50 years, it has to be a super mature business, which is good. But I mean, you know, you don't expect 3M or Procter and Gamble or Johnson Johnson to skyrocket and
They're not going to have
eat
a
the
ton
crap
of
out of the
growth.
market all the time, right?
Right.
It's like good and steady stocks that you don't really mind having them. They're good, but they're not incredible either. It's just, this is like classic buy and hold. So I have some of them, but I prefer to have like stuff that are a little bit like more in the range of the 10 years dividend increase, like the dividend achievers that they call. But then you have to do more screening, obviously, because a lot of companies reach 10 years, but eventually they hit a recession or whatever, and then they get into trouble. So
it seems I really appreciate the way that you approach dividends, because a lot of folks, at least it seems, that might have like a more superficial understanding of them, just try to find like these really high yields, pour a bunch of money in these stocks, and then just hope it stays that way. And for me, what always turned me off from that was exactly what you're talking about, the ability for like capital to appreciate, because dividends can be a kicker. And once you have, you know, 10, $15 million, sure, you can do well off of dividends alone. But I think that you still miss the main source of value in stocks, which is their growth. That's where you're going to make most of your money. So I think that's like a really, I don't know, it's like a refreshing perspective you have compared to like a lot of information I've consumed on dividends, because everybody's always just talking about, well, you know, in order to make this number of dollars a month, you got to invest this much money in these companies. And then you're like, yeah, that works. But then you look at some of them. I mean, I think ExxonMobil for a while had a pretty high yield. I think I saw it once where it's like 8% or something like that. And, you know, now it's already down to 5. You know, they've already cut that down. And it's, you know, anybody that looked at that was like, that's not sustainable for them. But
well, actually, the thing that happened with ExxonMobil is they didn't cut their dividend. They actually kept it alive, and the stock price recovered. So this is why you went from 8% to 5. It's just because the stock price that they increased. So that's right. Not too bad,
because it was down at like 30 or something.
But just add maybe, I don't know, add 9 months to the crisis where we have no news about the vaccine, and instead of like this, like have Pfizer discover the vaccine this November instead of last year, and they would have probably cut their dividend.
Right.
It was just a matter, at this point, it was just a matter of time. There was like so many energy stocks that cut their dividend or didn't even recover, because sometimes like people are getting very excited about the energy boom that we have right now. But they forgot that they got an oil bust in 2015, and most of them never recovered from that oil bust, you know? So it's one thing to buy a stock at $5 and then it goes back to 15 and then you feel like a genius. But if you were like 5 years ago, that stock was worth like $65. So yeah, it went from 5 to 15, but still, I mean, the original price was like $65. So someone that has it for like 3, 4, 5, 10 years, they're still losing money on it. So there's nothing to be like, it was just good for people that saw the opportunity and put new cash in. So if you did that, you did a lot of money. But if you thought during the last oil bust in 2015, and then you put your money back then, because then again, stock price went down big time, but they kept going down after that. They never fully recovered from this one.
Yeah, because I was looking, it looks like sometime 2016, ExxonMobil was up at like 93, and then it dropped to like 32 last year, and then now it's back up near 60. That's, that one's just been interesting to watch.
But it's pretty much the trend for all of them. So if you bought it at 30, you feel like a genius today, and you're just like, yeah, energy stock rocks. But then if you bought it at 60, like you said, well, you're not that excited.
Right. Yeah. You're like, shit, I'm just trying to break even, man. Yeah. So I have 2 more questions for you. The first one, and we talked a little bit about this before we started, but again, this is the selfish question of the session. I definitely respect the Canadian markets. I know, like you said, I know a bit about the banks there. I know obviously the rail company just because I've traded that one before, but I'd like to understand just a little bit more about how you approach trading the Canadian stock market and the US stock market. Like, what do you like to do in the different markets, and how do you view the different markets?
What is very interesting in Canada, I'd say,
Is
is
that you guys are all so fucking nice? That's
yeah.
like
And apparently we hate competition, so we have a lot of oligopoly, so that's great. It's probably related to the fact that we're
yeah,
nice.
now I get it.
Yeah, because I talk about banks, but we have the same thing with telecoms, and we have the same thing with railroads and with some utilities. So
That's
you
really
have
curious.
you have those specific sectors that are very, very nice, and REITs as well. We have like very stable REITs over there,
Right.
mostly because they just, like, they play in their sandbox, and they
Right.
don't necessarily go elsewhere, but nobody comes in their sandbox either.
Right.
So they're all happy with that, and it's all good. And this is where you can make a lot of money out of it, because margins are ridiculous. And on top of liking paying taxes, we also like to pay very high fees for cell packages. So cell phone, all the wireless industry are making like ridiculous profit because we pay like ridiculous fees every month due to that oligopoly. And even like, I don't know, I think it was like roughly 10 years ago, Verizon looked at the Canadian market, and there was like
Yeah.
this big rumor that they would enter the Canadian market. And they looked at it and they were just like, man, I think we're going to make a target. We're just going to come in, get hit, and then we're going to get back. So they decided to buy back their shares of Vodafone instead, but they
Right.
so they decided not to go ahead with that. It was just like too hard to like go into that and get some piece of the pie, so they just forget about it. And this is what I like about the Canadian market. It's not operating that fast, so you have like those cash cows that still bring in some good decent growth. So telecoms, utilities, REITs, and banks are like definitely great places to be. If you like to trade on opportunities, well, we have a lot of oil and gas, obviously, and a lot of gold mining stocks. Again, I'm not big on those, but there are like some opportunities to be made if you're fast enough to buy and sell quickly.
Right.
But this is how I approach it. I really love those companies. And one thing is, you have a lot of like smaller players that nobody talks about, because the press is not that big. And honestly, if you look at like whatever, like financial analysts, like YouTube podcasts, like the same names comes all the time. And then you have like those small caps paying dividend that are amazing, but nobody talks about them anymore. And then one day they just woke up and say, oh my God, this one is cool. And then it goes up by like 40%. So this is what I like as well. So, but like really tiny companies that you have to dig a little bit further, but yeah, that's great.
And then when do you choose to go to like the US markets out? If is there like certain companies that just draw you to the US side of things? Yeah, just curious your thoughts on that.
Yeah.
Part.
So I don't like to invest in ADRs and companies that are outside of North America. So I rather invest in companies that are based here, but they have strong exposure to international markets. It's very hard to find in Canada. So this is like one place where I really like to do my shopping, is to like find companies that are, or like, we don't have like BlackRock, for example.
Right.
Like BlackRock, like largest asset manager in the world, largest ETF manufacturers. I mean, we don't have that kind of company in Canada, like the Microsoft of this world, Apple as well, same thing. So I kind of like either tech stocks and international exposure. Those are the two things that I will get from the US stocks. And then I'm going to take like some sectors like utilities, banks, telecoms. I'm going to pick them from in Canada. Because usually what they do is that they use the same technique as Canadian banks. They have like a strong fortress in Canada, and then they go seek the growth actually in the US most of the time. So
right. Interesting. Got it. And then I have one last question for you. We talked a little bit about your strategies. We talked about some of the stuff you like to look at. We talked about 2021. So I figured the last question could be your thoughts on 2022, because one of the things that you mentioned that I really identify with is just your overall performance of this year compared to the S&P 500 in this year as a vacuum, and then, in a longer time frame. Because I experienced some of that last year, where during the big rebound out of COVID, I missed a lot of that because I was definitely anticipating a longer bear market out of that. So I missed a lot of opportunity to the upside there. And I've been doing a lot of revamping on how I maintain sensitivity to current market conditions, even though I've been trading for, over 14 years now. So I have strategies and the way that I like to deploy based on that entire time frame, but almost like moving averages. I like to have like an exponential moving average side where I maintain some, relevance to how things are happening right now. So I'd be really curious to understand, after your 2021, how are you looking at 2022?
Well, for me, there's like two things that could happen in 2022, in the sense that either the party is going to continue hard. And it's kind of funny because when the pandemic happened, I was tweeting about that, say, you know what, we may have a scenario where we're going to enter into another like roaring 20s.
Right.
It's possible that we're going to run another bull market that would last for another 5, 6, 7 years, because there's so much liquidity in the market. Interest rates is so low. So great companies have everything they need. They can borrow money for nothing and then create value for shareholders like easily. So this could lead to double-digit growth for many types of businesses going forward, and the party could continue for a while. So that is one thing. If it happens, I'm pretty sure I'm going to lag a little bit behind, but at the same time, the more we move forward towards like higher level, at one point, it was just going to be healthy to have a good correction.
Yeah.
And if it ever happens in 2022, which I'm not sure it's going to happen, but I wouldn't be surprised if we're ending the year like down, not catastrophic something, but maybe like down 10%. That would make sense. I mean, interest rates are going to rise, and whenever it's going to be official, it's kind of funny because everybody expect that. But whenever the Fed or the Central Bank of Canada is going to say, we're going to rise interest rates, we're going to see the market drop. I don't know why. It's kind of funny because everybody knows it, but for some reason, we're all going to be surprised, right? So this is not good news. The variance, I mean, it's going like from one place to another. It's kind of funny because like the week before we started hearing about the variants, we just booked a trip to Kilimanjaro like next summer. So it was like, oh, we're going to hike Kilimanjaro.
Tanzania is really cool. I've been there.
Oh yeah, I told my friend, I'm going to hop on a container in an illegal boat if I must, but I'm going to Africa next year. I don't
figure
care
out how you can get there. Yep.
So I figured that I'm not, in 2020 or 2021 or 2019, I didn't move my portfolio that much because I like the way it is invested. What's going to change is the 10% of my speculative plays that I might go one place or another. And the other thing I did is we had a crazy housing market in Canada this year, probably because of the pandemic. I'm living like an hour away from Montreal, so a lot of people now they're doing like they work remotely, and they'd rather be like a little bit more in a like semi-rural place where there's like more natures and we have like an acreage of land or whatever. So housing has been very good. I had no intention of moving. So what I did to make sure that I'm ready for 2022 is I remortgaged my house, increased my line of credit on it. So now I have like a lot of money that is ready to be deployed because I'm already 100% invested. So that sucks when the market goes down because
when there's good opportunities. Yeah.
So this time I'm like, you know what? In 2020, in March 2020, I was like desperately looking for money to invest. And I was like, what can I do? Can I borrow from a friend or something?
Listen, child labor is still a thing. You got 3 kids, just pull them out to work.
So this time I'm definitely ready to be able to like just do some swing trades on that part. But for my core portfolio, I'm not going to change anything. I think, as I mentioned earlier, in 2021, we all have the feeling that we can buy anything and make money out of it. Yeah. But a lot of investors became complacent. And now they're freaking out if a stock drops by 15%, which is totally normal. And
I
then
get
it's kind of
such a
funny because
kick out of that. There's like a post
yeah,
I saw on Reddit. Somebody's just like, when will the blood stop? And I'm like, what is
which blood?
8%, dude? Like, what are you talking about?
And that's like 10% or 8% like from the peak. But if you
Right.
look year to date, you're still in positive, and you're just like,
Right.
what are you complaining? Your
Right.
stock went up like 40% in 6 months. That's not real.
Right.
And I do like webinar, I do a bunch of webinars, and sometimes people are just like, yeah, I'm bleeding out on this one, and I'm like, yeah, well, maybe you bought at the peak and then you don't feel good about it. But if you look
Sure.
at the run that the stock had over the past year, 2 years, 5 years, yeah, it was about time there was a small correction. Like some dudes decided to take some profit out of it, and that's just fine.
I like to tell people all the time. I was like, I know this may come as news, but the market actually moves in two directions. It comes down also.
So that's why I don't want to change the rest of my portfolio, because this, I've made my due diligence on it. In 2020, I even reviewed them with, an angle that there must be lockdowns and stuff like that we're not used to. And I've reviewed one by one and say, okay, so I'm comfortable with those companies. They have robust balance sheet, and they're going to survive the next recession, no matter what it is. They have proven it in the past as well. That's super important. So for that reason, I'm just, you know what, this money is good. I don't have to touch it. Speculative plays going to move a little bit. And then I've made sure that I have like borrowing money ready to draw right away, so I can invest in the market if there's a crash. This is how I enter in 2022, because trying to time the market crash is almost impossible.
Right.
I mean, I know a lot of people in 2018, when it started to go down, they're just like, yeah, I sold. I'm in full cash now. I'm going to wait for the right moment.
Still waiting.
I mean, yeah. I mean, who would have guessed that the bottom of the market would have been Christmas, the day after Christmas?
Yep.
You're just like, oh no, kids, I'm not going to play with you. Daddy has to open his computer.
Yeah.
Today's the day. And I'm like, what is it?
Yep. Yeah.
But it's impossible to know. So.
Yeah. And it's exactly that, right? I actually saw a post on your Twitter with like a chart, that says, somebody said, well, I'm going to wait for the dip. And that happens all the time. That's
waiting.
I feel like trying to time the market. There's obviously a very significant allure to it. It seems great, right? If you could pick bottoms, pick tops, that would be awesome. But it's literally just not practical. We just don't have that capability.
It's really playing Monday morning quarterback, actually.
Yeah.
So
yeah.
When you look back, you're just like, yeah, that was obvious. Why did you do it?
Oh, I love it when people, talk about a previous trade and all the technical analysis they did at that point. And you're like, bro, come on, man. You literally got lucky, and now you're drawing lines on a chart to rationalize it. There's nothing wrong with being lucky, right? Like, It's always good to put yourself in a position to be lucky, but let's call a fucking spade here. And that line that you drew on that chart meant literally nothing. I got to say, it's been like just really, really interesting to learn a little bit more about your perspective and the way you approach the markets. Like I said, for me, and even my mentor, he's in his 80s now, and he still trades derivatives almost exclusively. So for me and like my small trading bubble, we spend most of the time on derivatives. So it's really interesting to learn, a little bit about somebody else's approach in a different perspective. So thank you for taking some time to share that with me.
Yeah, it has been a lot of fun. And actually, I'd like to have you on my channel at one point, because I'm actually same thing, really selfish, but I like to understand a little bit more about like how you use those options and derivative products to make your trade. So
yeah, it'd be super fun.
Great.
Yeah, it'd be super fun. It's the approach that I have when it comes to derivatives is really boring. And, there's just not a lot of fun involved, but it's very similar to your approach, where the speculative side, that's where, if we're looking for some sparks to fly, that's where it's going to be. And otherwise the core holdings are pretty slow and steady. My mentor always said, like once you get to a certain amount of money in your portfolio, beating the market really becomes more and more meaningless. And for him, and this is something he's impressed on me really hard, is reduction in variance and consistency in your returns becomes more important. So I really keyed into that when you're talking about your strategy, even this year. I feel like your approach to it makes a ton of sense. And it, like, you even stand behind what you said when you're saying next year, you know, I'm going to keep deploying the way I am because you're comfortable with it. I think that's awesome.
That's great. It's been a lot of fun, Eric.
Yeah. Well, until next time, we will catch you later.
For sure.
Take care.